Hey, good afternoon, everyone. Um, I'm really excited that everybody's here. We have a much bigger house than I normally anticipated. Um, Let me just turn the room on, and I'm going to welcome everybody. And this is our 10-part series, and it's going to be 60 minutes every Wednesday from 1 to 2 p.m. All sessions will be recorded and they'll be provided to you on a closed link. And I just wanted to go over the syllabus with you a little bit. Parts one and two are going to be to teach you how to trade price action. And I'm going to talk a lot more about that, but that is essentially the linchpin of successful day trading. In part three or module three, we're going to talk about combining price action with volume. And then in 4 and 5, we're going to be adding price. We're going to be adding market structure to price action. And then in 6 and 7, we're going to take price action and market structure and add indicator confirmation. So in other words, what we're doing is we're going to start out trading with a methodology that provides us with a lot of sensitivity. We're going to get some great entries, but also the potential to take a lot of losers. And that's trading with price action. And as we move forward, we're going to layer things on to filter out the bad trades. Market structure is a filter, and then ultimately indicator confirmation is an additional filter, so that ultimately our goal is to trade with a tremendous amount of specificity. Now parts 8, 9, and 10, and we are really critical. What we're going to talk about is trade management strategies. And these are the things that are very often glossed over. And ultimately what trade management strategies are is the risk to reward that you take on every trade. And if you were in my initial introductory webinar, you know that a lot of traders set a target, set a stop, and their target, whether they take one target or two targets or three targets, and you should always scale out of a trade, is simply unrealistic based on the volatility of the trading instrument that you trade. Also, your stop may be too tight and cause you to. Every single market has an intrinsic stutter, and what you have to do is avoid that stutter with your stop, so that just that natural movement back and forth is just not going to take you out of the trade. So you have to set a very rational stop, and you have to set targets that are achievable. And that's all based on the average true range of your trading instrument. So what we're going to do is we're going to look, you traders in the room are going to give me instruments that you like to trade, and I'm going to show you how looking at the average true range of the instrument will allow us to set up a trade management strategy that optimizes our profit on the trade. It's going to set a rational, reasonable stop based on math. And it's going to set a first target, a second target, if you want, a third target, depending upon how you want to take the trade out. And some of this is discretionary and some of it is based on risk tolerance, but ultimately, the final target with which you move to close the trade is going to be based on the intrinsic volatility of the instrument you're trading. And like I said, I hear over and over again, I want a 3-to-1 or 1-to-3 risk. If I risk $1, I want to make $3. Sometimes that's just not possible. And I'm going to show you how to set those up relatively easily, so you really can garner as much profit on a trade as possible. I'm also going to show you how to do market scanning. You can scan the markets in many different ways. If you trade stocks, there's one way of scanning. If you trade Forex, there's another way. But ultimately what it comes down to is I'm going to show you our scanner. and I'm going to show you how we break these things down into multiple independent variables, and how when our scanner clicks off, you're ultimately going to probably get yourself a great entry. Now, the thing that I want to teach you to avoid is market scanners that rely on rising and falling triangles and rising and falling channels. They are not going to get you winning trades. And then ultimately, we're going to sit and trade a live market together. Only I'm going to let you trade the live market. I am not going to press the button. Everyone's going to get an opportunity to trade along. And what we'll do is, if we're doing this in the afternoon, I'll simply record a few markets, and we'll trade those. And if we're trading on market replay, it doesn't make any difference what market we're trading, because the trading opportunities we get, the time frames that we trade, our strategy is all independent of that. So everyone's going to get an opportunity to actually trade live. I want to see, in order to get your diploma, you're going to have to make some money in trading live and apply all of the things that we've discussed here in a really precise and disciplined way. Now let's just take for a minute. Now, and this may take more than an hour. So we're going to go until I'm finished, but because I have a curriculum based on the 10 modules, and if they take more than an hour, we're just going to take more than an hour. Now, we do have to remember that 90 to 95% of all day traders go broke. And that's because they do rely on the same trading methodology. And one of the things I want to do here is I want everybody to unlearn everything they've been taught. Now, some of the things you've been taught you're going to find are correct. But for the moment, let's start with a blank slate and make like you've learned nothing. Because what I want to do is layer on what I believe is the way that's going to make it profitable. And I don't think it's the only way to make it profitable, but I think it's one way that works. And there are 1,000 ways out there that don't work. So let's get rid of all the bad stuff we've been taught and the things that really bust out most day traders and swing traders for that matter. Now, the easiest thing to do is to teach a day trader to use indicators to trade to base their technical analysis on, and to give them entries. And those entries are, they're all of them. They're stochastic, they're RSI, they're Williams K. Those are all oscillators. There's MACD, which is just moving average crossover. There's Fibonacci, and there's Elliott wave. And like I said, I've mentored a huge number of students, and the first thing that I see is the vast majority of them are looking for, and I mentioned this in the initial introduction webinar, that they're the one more indicator trader. They're just looking for that one additional indicator that's going to get them there. And it's Heikin Ashi, it's candlestick colors. It's something that's going to get them a trading entry. And I'm telling you, it's just the easy way. What we're going to use indicators, and if you know how I trade, you know that we use real different types of indicators. We're going to discard these basic indicators and get rid of them because they're just going to cost us our entire bankroll. We're going to use different kinds of indicators, but the core of our trading is going to be based on market structure and price action. And we're going to go into trading price action today. And it's not very exciting, but it is the foundation for day trading. And it is the component of day trading that is most rarely taught because most traders don't understand it. And also some of the principles that underlie Japanese candlesticks are a little bit nebulous. I have read Steve Nissen's books. There's 2 books he published. They're each 150 pages. I read them literally like 7 times each. And there are a lot of candlestick formations, but there are only certain formations that provide you with enough information that actually increase the probability of using them for a trading trigger. So we're going to discard all of the candlestick formations that don't work, and we're only going to encompass in our trading the candlestick formations that do work. So we're going to simplify this quite a bit. But the candlestick formations that do work, you're going to have to learn how to see and spot almost as if they jump out in your face. Because this is the foundation for day trading. Now, a lot of traders, and this is really important to know, they buy what they call them momo breakouts. It's a breakout on momentum. So they'll trade a high of day stock breakout or a futures breakout. It doesn't make any difference what the trading instrument is or what the market, but they're going to buy the breakout, either the high of day or the all-time high. It doesn't matter. And they buy it when they think the stock or the futures market or the Forex market has momentum. But what is momentum? How do we assess momentum? Momentum is an indicator analytic. Now, momentum is either based on an oscillator or it's based on MACD, but that is the essence of momentum. And anything that's based on an oscillator like that isn't going to guarantee you anything. The breakout could go 3 or 4 cents or ticks up and then collapse. If you buy breakouts like that, and a lot of traders do, you're going to wind up losing your money. And a lot of traders buy reversals. They call tops and they call bottoms. I'm going to show you how candlestick formations, candlestick patterns, call a lot of tops and bottoms, but they don't do it with the predictive value that we need in order to make money. So we don't trade against institutional money. And today I took some rugged counter trend trades, and they didn't work. And the ones that work today were the trend trades, and they have to be your bread and butter trades. So what we want to do is we want to learn how to buy really high probability trend continuation signals. And when we do, the predictive value of a trading entry can really be over 90%. You just have to be patient. And if I would have just taken the trend trades today, we would have had a fabulous day. Now, there are certain counter trend trades I'm going to teach you that do have a high predictive value of winning. But I was a little too wild today, and it cost us. But we really broke back with our bread and butter. Now, move my slides. What ultimately we're trying to do, as I mentioned before, is we want to trade with a tremendous degree of specificity. We're not looking to get into the winners. We're looking to avoid every potential losing setup. If you trade, there's a lot of people out there who just want to trade price action. They're the purists. If you do, you're going to trade with much too much sensitivity. If you just trade with price action and market structure, you're starting to push the specificity, but you still are going to trade with too much sensitivity. And then if you use the entry and confirm it with the appropriate indicator analysis, that's where you layer on enough specificity to drive your trade into the profitable territory. And also having the appropriate trade management strategy allows you to milk the trade for as much money as you can, which is really, really important. So the first step in finding good trades is what I'm going to show you. Okay, now most trade, I don't want to beat a dead horse here because we're never going to go back to this again. But most entry strategies just don't work. They've never been quantified mathematically. You don't know what the predictive value is. You don't know their sensitivity and specificity, and they cannot be traded profitably unless you understand the math behind the trading entry. The entry has no validity whatsoever. So price action is critical, and this is what we're going to do the rest of the session. Every candle informs you as the trader about market sentiment. Really gives you outstanding information about what traders are thinking. Now remember, right now, we are creating a trading strategy based on a lot of sensitivity. This is not where we're going to wind up, but this is the foundation. So we must be pattern traders, but the patterns that we use in which we place into market structure and confirm with indicator analysis have to have a positive predictive value of at least 75%. That gives us the edge we need to make the moolah. And this is what's going to provide us with our winning entries. So we must trade highly precise patterns and have them confirmed down the line. Now let's take a look at the candlestick. This is going to be a review for some. It's going to be new for others, but it's never a bad thing to review this information. Now, on an up candle, the wick, this high wick here is always the high of the move. The bottom wick is always the low of the move. If it's an up candle, which is the orange candle, it's a down candle, it opens here and closes here. If it's an up move, the candle opens here and closes here. Let me just hide this. Now, this is a candle without any wick. And this is an up candle, it opens here, it closes here. Here's a down candle, it opens here and it closes here. When a candle has no wick on this up move, it tells you that buyers have tremendous conviction. They did not let the sellers create a single tick of wick at the top of the candle. They didn't let sellers push that move down one tick. It closed at the high. And that's really important in assessing market sentiment. And the exact same thing is true for the reverse candle. That candle closes at the low. These sellers did not let buyers come in and push that close one tick off the low. And that is what we are looking for. We are looking for these kind of candles that tell us within that candle, there's either a tremendous amount of buying conviction or a tremendous amount of selling conviction. Now, this is why it is suicide to take a trade intra-candle. Because if you do, you don't let the buyers and sellers that are participating in this trade fully express themselves. You don't know, and I'm going to show you another slide how you can have intra-candle volatility. Like you don't know in this candle how it moved intra-candle. Maybe this candle came down one tick before the close, and it came all the way back up to one tick below the open. Then it came all the way down. Then it came all the way up. And it zigzagged inside here. That's what can happen if you try to take a trade intra-candle. You want to wait for the ultimate outcome, which is the full expression of the power of the buyers and sellers in this particular candle. Now, this is a candle. The only thing I wanted to do with this slide is to emphasize this. When there's a big candle body, you know that the buyers here and the sellers here are trading this candle in the direction they want with a tremendous amount of conviction. When there's a small candle body, now in range bars, you can't get this, but you can with a tick and you can with a time chart. When there's a small candle body, there is really no conviction here in the power of the bulls or the power of the bears. These are the kind of trades, these are the kind of candle formations we never use as entries. because we can't tell who's really in charge at the close of this candle. Now, these are spinning tops, and this is a good candlestick formation that we have to watch out for. The reason we watch out for it is we never take an entry on a spinning top, and a spinning top never calls a top or never calls a bottom, because on a bullish spinning top, the market comes all the way up here, it goes all the way down, but it only closes a tick or two above the open. So the candle body is small, and these are all either called shadows or wicks, and those are big. And it shows you the indecision here and the lack of power in the bulls. And it's the same thing here. This shows you the tremendous indecision or the lack of overall power in either the bulls or the bears. These are periods of indecision. And the next logical step in a market where we're just not really sure what's going on is the doji. A doji, a classic doji, has no candle body at all. Or it's got a candle body that's so tiny, it's maybe 1 tick or 1 cent or 1 pip. It's really small. And here, this is essentially where the power of the bulls equals the power of the bears. Now, some people use dojis to call tops and call bottoms, but what we do here, we are never going to do that. We're going to consider a doji to simply be a candle of indecision. And we are going to stay away from taking an entry on a doji always. So when we see a doji form at the top, we are just going to stand aside. When we see a doji form at the bottom, we are going to stand aside. We want to trade candles with big candle bodies. Those are candles that have a lot of power in either the bullish or bearish direction. As those candle bodies shrink from spinning tops to dojis, that's where the power of the bears becomes more and more equal until we get to the point where we just don't want to take a trade on these candles. These could be continuation candles or reversal candles. We don't know until the next candle forms, so we can't use these to trigger an entry. And what we're looking for are candlestick formations that confirm our entries. We don't care on a continuation trade what's going to happen unless we got a doji formation and the doji was used as a entry. Remember, we're looking for trend continuation signals. We're going to go over that a lot more, but we're going to stand aside on any candle with a small candle body where the power of the bulls equals the power of the bears. And you remember again, indicator analysis is irrelevant here. And here, market structure is only semi-relevant because we're not looking to get an entry. Now, here's your long upper shadow, and here's your long lower shadow. Now, let me explain what's going on, because these are important candles. This is a hammer, and this is a hanging man. I'm sorry, this is a hammer, and this is a hanging man. Now, their classic candlestick dogma gives you a classic hammer, and I think they call them upside down hammers or reversal hammers. We're not going to look at that because it's too confusing, and the chances of getting an upside down hammer as a trend continuation signal or as a trend reversal signal is so rare that we're just going to let go of them. I mean, you see them very rarely, and if they're so unusual that they're not worth chasing, we not only want to understand Japanese candlesticks, but we also want to get rid of the things that happen so obscurely, it just confounds our analysis. So what we have here is a hammer. A hammer is always a bullish trend reversal signal when it occurs at the right spot. And I hope you can see, we're going to go over this more, but these are the kind of patterns we're looking for. And what happens, let's go over the bullish hammer first. The candle opens here. Buyers, we don't know what happens intra-candle, but we can tell what happens throughout what ultimately is the expression of buyers and sellers in this candle. Now, buyers try to push it up. Sellers push this wick all the way to the downside. But they fail because buyers ultimately are able to push it above the open and push it up to the top. Now, sometimes this candle body will sit, there'll be no upper wick. The important thing is the attempt by sellers to push this down is failed, and this long lower shadow really shows you a bear failure. So every time you see a hammer, you're looking for a potential reversal to the upside. It's a bullish formation. Now, this is a bearish formation. Here's where the bulls tried to push the market all the way up and fail. Bears are able to close the market, bring the market back down lower. You ultimately get a close that's lower. So this bullish attempt to push the market up fails. So what we're going to look at is the bullish hammer and the bearish hanging man. Now, here are 1, 2, 3, 4, 5, 6 candlestick formations. Now, I'm not going to make you type it out, but you should be able to know that in candle 1, you have a strong bullish sentiment. It's a big candle body. And this is a potential bullish entry. Here, very powerful bearish sentiment. And this is a potential short entry. You can see how we're building our trading strategy here because we're looking for candles that express in their formation and close a strong bullish pattern or a strong bearish pattern. Now, these are small candle bodies, and they tell you that the power of the bulls and the power of the bears is insufficient to give us a trading entry. Now, these are both hammers. Now, this is a classic hammer, and this is a reversal hammer, and we're not going to worry about these. And this is your classic hanging man. So we're going to look at for the top of formation, this one, and we're going to look at this one. This is a bullish formation because the bears failed to push the market down, and this is a bearish formation because the bulls failed to push the market up. These are all variations of dojis. This is a classic spinning top, and these show market indecision where the power of the bulls equals the power of the bears. And here's the long white candles indicate the bulls are in control. The black candles indicate that the bears are in control. The small candlesticks show that neither the bulls nor the bears are in control. A long lower shadow shows that there's a bear failure and that the bulls are in control. A long upper shadow shows that there's a bull failure and that the bears are in control. And a long upper and lower shadow indicate that both the bulls and the bears are equal in power. Now, trading activity or intra-candle volatility varies, and in retrospective analysis of price cannot be known. And this is an important point. It's hard to look back at a trade and see how it would have done for you. Because let's say you have a candle that opens here and closes here. You don't know how price moved intra-candle. Now let's say you're trading a 2-hour candle or a 4-hour candle or a daily candle. All you know is at the close of the day, you have a very bullish day. You have a huge body. And the bulls ultimately wound up being in control of this day. It could have opened here, gone down this one tick to create this wick, and then gone straight up, and then the bears were able to push it off the high by a tick. Or it could have gone up and down, not just once, but 3, 4, 5 times. So when you do a retrospective analysis, just remember, you can never tell how your trade would have done because you can't tell how price moved intra-candle. The only way you can do that assessment is by looking at market replay data. Now, this is a hammer or a reverse hanging man. We are not going to look at that reverse hanging man. We're just going to look at the hammer. And we already discussed, and we're going to move on from this slide, how this long wick shows the bears failed and bulls ultimately won out, pushing this trade to the top and creating an upper positive body, a long body. And here is the hammer. And we look for it as a bottoming formation. Now, optimally, the next candle should gap up just a little bit. Now, if you're trading range, it automatically gaps up. But if you're trading ticker time, it doesn't necessarily have to. But the best entry is going to be obtained when right after your bullish hammer, you get a slight gap up in price and you get a continuation to the upside. Now remember, we're not trading right now with a lot of specificity. We're trading with sensitivity. We're going to layer it. But being able to see a hammer as a bullish formation is extremely important. And here's your hanging man. You can see. Oh, let me just change this. Inverted hammer. They call this an inverted hanging man. This is what we call a hanging man. And what I'm trying to do is simply simplify the nomenclature. And Japanese candlestick nomenclature is confusing. So let me just go here, back to here. Here's our hammer, our bullish hammer. And here is our hanging man. Japanese candlestick dogma calls it an inverted hanging man. We're not going to look at it that way. This is our hanging man. This is a bull failure. The bulls pushed the candle all the way to the top. Ultimately, the bears took over. They got the candle to close to the downside. And you can see this next candle opened a tick or two below. You've got a little bit of a gap down and a successful trade. Now, if we come back here, they call us an inverted hammer. Let's just forget that. I don't want to confuse it because it's irrelevant. So a hammer and an inverted hammer are both bullish reversal patterns. Forget the inverted hammer. We're just looking at the hammer. And the hanging man is a bearish reversal pattern. So let's look actually at some trading entries. Now, here is the move up. And you can see here that I drew this blue line to show you that that's how far up the bulls were able to take the trade. And then the trade collapsed back in on itself and we got a down close. And even though now the next tick closed one tick below, this is a range, and down you go. Now, I created this hammer here, but I want you to understand this is just barely a hammer. A hammer should have a wick that's at least 1.5 to 2 times as big as the candle body. This is more, in looking back at this, I don't like this as a hammer. So let's get rid of it. This is a perfect hanging man. We want to demonstrate here what a tremendous failure the bulls were in trying to push the market up. And in looking at in this hammer, we want to show how much of a failure the bears were here in pushing this market to the bottom, and then ultimately the trade coming back. Now, that's a very nice hammer. And you can see we got a trend continuation. Here's another really nice hammer. Big wick, major bear failure. And here, forget the inverted, this is our hanging man. And again, a big bull failure. You see this candle here? A big bull failure. Candle here, bull failure. But we want to look at hanging men and hammers as reversal patterns, not continuation patterns. When you see it on the trade and you're in the trade, it should make you feel good. Because when the candle comes up here and then ultimately collapses to give you a big upper shadow, the possibility of a trend continuation is real strong. But we're looking at these as bottoming formations and topping formations, not necessarily having the predictive value to give us a trend continuation signal. Because one of the important things about Japanese candlesticks is putting them in their proper place. And hammers and hanging men are topping formations and they're bottoming formations. Now, I put this as an inverted simply to stay with classic Japanese candlestick dogma, but forget about it. This is our hanging man. Huge upper wick, major bull failure, small candle body that closes to the downside, and down you go. This is not so much of a bullish hammer. Maybe we can classify it as such. Here's a great hammer, and here's a terrific hammer. Now, the important thing about a hammer and a hanging man is they have to have at least 2 ticks on an 8 range, or depending upon the size. Remember, you want the candle, you want the wick to be about 1.5 to 2 times the size of the candle body. But if the candle body disintegrates to where it's almost imperceptible, you wind up with a doji. So you have to be careful. You need to have some significant candle body to show that there is bull power here, and you just don't have a modified doji. And here's a nice hanging man. Okay, now I'm looking at the chat. Let me go to chat. Okay, no problem, guys. Now, I want you to tell me, I would really like you to type in, what is candlestick formation 1? Come on, we've got a lot of people in the room. Tell me what you think it is. What do you think? Correct. No, it's William. Okay. We have a bunch of dojis and we have one hammer. It's a doji. Okay? No. Well, you know what? It could be classified as an evening star, Kyle. You're correct. And the reason, I'm sorry, Thomas, the reason I did not classify it as an evening star is because of the fact that I threw the evening star formation into simply the doji pattern. And I call it a modified doji. And that's really smart. You obviously know your candlestick formation. And the reason is that ultimately an evening star and a doji show the same thing. What they're showing is that the power of the bulls. So the answer is it's a doji. And the reason it's not an engulfing candle, and it's not a hammer majid because it doesn't have any candle body. It's got to have a candle body to be considered a hammer or a hanging man. So I take the evening star and shooting star formation and simply create what I consider to be a modified doji. And like I said, I'm trying to simplify the formations because all we want to do is ultimately use nomenclature that gives us a great sense of what buyers and sellers are telling us in this particular situation. And this is a major bull failure. But the bears could not push this market down at all to give us one tick of down candle. Oh no, I'm sorry. Okay, I'm sorry. I meant one. So I'll take it back, Majid. So this is a doji. Total indecision. Bears or bulls do not have enough power to create any candle body. Now, how about number two? What is that? That should be an easy one for you guys. You got it. Thank you, William. It's a hanging man. That's correct. And you can see how it's a bull failure. Bulls try to push the wick all the way up. Correct. Okay, Thomas, agreed. But we're going to call this simply correct. We're just going to call this a hanging man because the shooting star and the evening star don't really add any more texture or context to our candlestick nomenclature except beyond what a hanging man does here. And this is a hanging man. So all we're trying to do is coordinate and coalesce our nomenclature based upon the sentiment of buyers and sellers in these candles and sort of simplify it. But you're correct. Now, I'm just going to say, like in number three could be an engulfing candle. And it is an engulfing candle. And we're going to talk about engulfing candles later. So some of these have more than one. They can be labeled in more than one way. But for our ability to assess whether we want to take a short trade here or not, whether to stand aside, we want to keep our nomenclature simple. So in number three, I know that everyone in the room, this is another hanging man. It is a bull failure. The bears do get to close the candle lower and create a candle body. A long wick gives us very bearish sentiment, and the trade continues down. And number four can be an engulfer or it's a hammer. And number five, I would like you to tell me what number five is. Come on, Thomas, you're the expert. Tell me what it is. This is all the stuff you really have to know. So you're going to get this on a link. You have to study this. It's really key that you learn this. So tell me what number five is. I put five in there on purpose. Okay, I'm not getting any feedback here. Come on. Okay. Actually, it's not undecided, Majid, and I'll show you why. It's not a hanging man. Nope. It's not a hammer. Remember, there's not enough wick here to make this a hammer. Correct, William. You are absolutely correct. What this is, we're gonna talk about it later, but this is a piercing candle. And the reason I put it in is be very careful when you classify a candle as a hammer or a hanging man. You've got to look for that wick to be 1.5 to 2 times the size of the candle body. And when you have a big candle body like this is really a piercing candle. And you're going to have an opportunity to review this. It's really important. And listen, this is not an exercise in boredom or futility. You're going to see how later, and I'm going to show you on these series of slides, how key it is to apply this in your trading and why almost nobody teaches it and why everybody doesn't make money. And you really have to know this. And we're going to put it in the proper context as we move forward. But understanding these entries in their bare form as they appear on a chart as topping or bottoming formations is really key. Now we're going to look at what's called a dark cloud cover. Again, these are entry candles. Now, the hammer and the hanging man are evidence of a bearish or bullish reversal. Now, we are not going to trade reversal patterns. What do we use those for? We use those signals as a way to avoid taking a trade when we're looking for a trend continuation. We are not going to take a trend continuation trade on a hammer or a hanging man. It's just because it's more evidence that we're going to get a bottoming and reversal or a topping and reversal. And this is what creates more specificity in our trading. So if we see the entry is a hanging man, we're going to be very careful about taking a long trade. So those are the things that we have to watch. Sure, Thomas. A hammer and a hanging man are evidence of trend reversal patterns. We're looking for the hanging man to call a top, and we're looking for the hammer to call a bottom. The hammer is a bottoming formation in which the bulls take over to push the market up. A hanging man is a topping formation in which the bears take over to push the candle down. Now, if we were to take an entry, let's say we wanted to take a trend continuation trade where we have a hammer or a hanging man. You lost sound? Hang on one sec. Let me see. Testing. How about now, Thomas? You have it back? Can you hear me? Testing. Can everybody hear me okay? Testing. I don't know what's happened. Testing. Okay, good. Okay. All right, well, so let me just repeat what I just said. We're looking for the hammer. It's good, we're good. We're looking we're looking for the hammer to be a bullish bottoming formation in which we're now looking to take a reversal to the upside. We're looking at the hanging man as a topping formation to then take the market to the downside. These are all evidence of a change in market sentiment. But our bread and butter trades are going to be trend continuation trades. So if almost all the trades we take are trend continuation trades, we are going to sidestep the hanging men. We're going to sidestep the hammers, and we're going to sidestep the dojis or modified dojis as entry candles because our trend continuation pattern doesn't have enough power in it to tell us that we've got a great potential trend continuation signal. So what we learn first is the topping and bottoming formations and the candles of indecision that we're going to avoid when we're looking to take a trend continuation trade. Now, if we look to take a topping and reverse or a bottoming and reverse, we're going to go broke. You cannot call a bottom or a top. You've got to trust me. The market will make a bottom when the institutional players decide the bottom is there. The market is not going to make a top again until the institutional players move aside, allow the retail/commercial traders to reverse the market. You cannot call a top or a bottom. You can sometimes, but what we're looking for are entry signals that give us the kind of precision, the predictive value that when we get in, we know 75 to 80% of our entries are going to be profitable, not risky trades. And if you want to take topping and bottoming signals, like a lot of people do, and a lot of people are taught to take, you're going to wind up getting really, really hurt. You've got to trade with the trend, and you got to trade with a multi-time frame trend. So when you're trading on the trading chart, we've now learned 3 patterns of trades to avoid taking an entry on. One is the hammer, one is the hanging man, and the other is the doji or the modified doji. And remember, I consider a spinning top to be nothing more really than a modified doji. It's where the upper wick and the bottom wick are equal and the candle body is extremely tiny. But we can just without confusing, if there's no candle body at all, it's a doji. It's a tiny, tiny candle body with an essentially equal upper and equal lower wick. You got a spinning top. These are also candles of indecision where we can't guarantee if we take an entry, we're going to get a trend continuation. Now we're going to look at signals that we're going to use that help us guarantee the trend continuation. And one of them is a dark cloud cover. Now, here's what happens. Here is the previous candle. And what we have to do, I don't want to put this into long patterns yet. I just want you to learn these individual signals. Later, we're going to trade them in complex patterns. So what you do is you have an up candle. And again, I reiterated here, here's the high, here's the low, here's the open, here's the close. Now, what you would like to see on a dark cloud cover is the candle opening price gap up a little bit from the high of this candle. So the market opens here, and then it pierces or covers here at least 1/2 of the candle body of the previous candle. Now you have to just look at it this way. You got buyers sitting in here. There's a predominance of buyers. That's why the candle went up. And you want to see enough selling conviction to pierce or cover these buyers and at least penetrate this candle body 1/2 of the way. If it does, you have a successful dark cloud cover. But remember, if this candle body is tiny and the candle body is small and the wick is long here and the wick is long here, there is no dark cloud cover. What I wanted to exemplify here is you need a nice up candle with a big candle body showing you that there's a lot of buying conviction, and then the dark cloud cover shows you the potential trend continuation to the downside with a lot of selling conviction. Now, this is a confirmation, but given the appropriate circumstances, we're going to be in this trade 1 tick below the close. because we're gonna go into that later. But this formation is extremely important. I'm going to show you that. The opposite of a dark cloud cover is a piercing candle. It's just exactly the opposite. You have a down candle, and remember, it's got to have a nice candle body. There's got to be a lot of buyers here, sellers with a lot of selling conviction. But buyers come in and they push this market at least one half the way through the candle body of the previous down candle. And this also has to be a candle that shows a lot of buying conviction. Tiny wicks, big candle body. Then you have the bullish engulfing. Here's the down close. Here, the buyers not only could pierce one half of the way through this down candle, they totally engulfed it. Now, for formal Japanese dogma, a candle engulfs if the low of the candle equals the high of the previous candle, and the high equals the low of the previous candle. It doesn't have to be a tick above, and this doesn't have to be a tick below. They can be equal. And this engulfing pattern is very, very strong. This is a great trend continuation signal. And here's your bearish engulfer. The buyers in this candle are blistered on this candle. Now, there's some really cool additional signals I'll share with you later where you get a double engulfer. And we have actually our software will call double engulfers for you right off the software. But I don't want to use software. I want you to trade without it right now. So we get the bullish trade, and sellers swamp the buyers here. And if this trade continues one tick below the close, all of these buyers are going to start getting stopped out. That's the power of the dark cloud cover and the bearish engulfer and the piercing candle and the bullish engulfer. So here are our formations. We have the doji, we have the bullish doji and the bearish doji, which for the most part, don't be concerned with. We're just going to look at a doji is a doji is a doji. I eliminated the reverse hanging man and the reverse hammer. We just have a hanging man and we have a hammer. We have a dark cloud cover, more bearish, the engulfing candle. We have the piercing candle, more bullish, the bullish engulfing candle. Now, I'll call these out for you because I'll make it a little bit easier. Now, one is clearly an engulfing candle. It swamps these sellers. And as this trade moves up, these counter trend sellers are all going to get stopped out and push the trade up. Now, as a trend, this is a trend continuation signal. It's a great one. This is a bearish engulfing candle. And down it goes. This is a little bit of a topping pattern. And what you have here is a hanging man. And down the trade goes. Now, this is a piercing candle. And 5 is a nothing. This does not get to push halfway through the down candle. And the wick and the candle body don't provide it with the kind of structure that allow us to call it a spinning top or a doji. So it simply doesn't allow us to confirm that the bulls or the bears are in control here. It doesn't give us any information regarding what's going to happen on the next candle. So we have an engulfer, a great trend continuation signal. We have a topping formation. This is a bull failure and a hanging man. We have right here, we have a piercing candle. And we have a few more. And I'm just going to, because we're running into I'm just going to tell you what they are because there's more. Now, this can be classified as an engulfing. Let me go back. No, remember the doji, the bullish, the dojis are evidence that a trend continuation may not happen. And the hanging, the first 1, 2, 3, 4, and 5 are candles of indecision. The dark cloud piercing candle, bullish engulfer, and bearish engulfer are the trend continuation candles. So this is not a trend continuation because all I want to do right now is just for you to learn the formation. You're going to see in the last few slides exactly correct. This is your trend continuation signal and down. I wasn't really honed in right now on giving you trading entries, on giving you trend continuation patterns. We're going to go into that next session. I just want you to be able to identify the patterns and say to yourself, okay, this is a topping pattern. This is a hanging man. Do I want to look for a trend continuation long here? And the answer is no. Here is a piercing candle. Do I have a potential trend continuation signal here? Yes. This is a nothing. Do I have a potential trend continuation signal here? No. So we know when to step aside and we know when to look for a trading entry. That's our goal in this module 1. And if we get that, you're going to see how everything will fit in and roll. Now, again, here's what I put this in for a reason. Now, 1 is a bottoming pattern, and that's a hammer, and that's an engulfer. Now, this is a topping pattern. 2, that's a hanging man. 3 is a hanging man. And you see what happens. They fail. 4 is a dark cloud cover. It goes down a tick, and then down it goes. The dark cloud cover works, but 3, which is the best topping pattern, which is the hanging man with a huge wick showing you a bull failure, and then a nice 2-tick candle body, perfect, shows you why we wouldn't take a trend continuation signal, but why we don't call tops and bottoms. We just don't want to enter a continuation trade to the upside on this kind of indecision that's signaled in this candle. Now, here is ultimately what we're going to learn next week. We're going to learn to put all this into the context of not yet market structure, but we're going to start creating channels and trends so we know when to actually look for a trading entry. Market structure is still a couple of modules away. And this is not as hard as it looks. But what we're doing here is we have an engulfing candle. Now, we're only looking for trend continuation signals. If we want to call this as a top, you're going to see that more often than not, you're going to get beat up and get run over. But when this candle comes back up here, these oval shapes I put in here, these are pivots. And this is a pivot with a lower high and a lower low. And it creates this down channel. And a down channel in a falling market on an engulfing candle entry is what gives you these great moves. Now, this is a nothing. It's not quite a piercing candle, and it certainly isn't a hammer. But what it creates is 2 rising pivots Here's a pivot, and here's a pivot, plus a consolidation channel. Now, what the guys who lose all the money would call this is they would call this a rising triangle or a rising pennant. What we're going to call it is an area of consolidation with subsequent rising pivots. Here's our entry. It's just short of bullish engulfing. And so it's a piercing candle, a very convincing piercing candle. And it comes right off the lower channel. These are the things that we're going to work on. Let me still have one more. These are the things that are going to work on. We're going to work on next week. We're going to look at where to take and look for a continuation pattern and how to find them. And let me tell you, they are not hard. And then once we build some structure into our trading, these trend continuation signals you're going to see how powerful they are. If this pivot did not continue down on an engulfer or a dark cloud cover, we have no entry. If this candle was a spinning top, if it was a topping candle, which would have been a hanging man, if it was a doji, we wouldn't take the trade. It would be the appropriate place to take the trade, but what we need to take the short continuation trade is we need an engulfing candle or we need a dark cloud cover. That's what creates the specificity we need to increase the precision of our trading entries so that we close in on that 75 to 80%. And remember, are we going to lose some winners? Yes. But are we going to sidestep a lot of losers? Yes. And that's our goal, is to sidestep losers. And what I'm going to do is I'm going to build you chart after chart, and we're going to go over pattern after pattern, and we're going to look at the appropriate place to take a trend continuation signal. And we're only going to take those trend continuation signals on the Japanese candlestick formations that tell us whether we have enough bearish conviction in a short trade or enough bullish conviction in a long trade. So the next session is going to be complex candlestick patterns that create entry signals like these. And we're going to be able to read these real easy. This area of consolidation is simple to read. And these sequentially higher pivots are also easy to read. We just have to be waiting one tick above. Now, if we entered here on this candle, I can't move this, unfortunately. It wouldn't have stopped out. We still would have gotten a winner. But I'm going to teach you a little bit about consolidation. I'm going to teach you more about trend continuation signals, and you will see why taking this first green candle up was not the optimal place to take it. It was the second green candle up. So let me say, are there any questions? Yes, it is. This is a triple bottom. Remember, bottoms and tops are one of the few things in Japanese candlestick dogma that include the wick. So this is actually a bottom here, and there's your triple bottom. I didn't want to go into triple bottoms, Thomas, because you're a little bit, you're a little bit ahead, but that is also a triple bottom. I just didn't want to mention it. So I don't want to throw too much stuff, but we're going to be looking at double tops and triple tops, double tops and double bottoms or triple bottoms. We're going to be looking at tweezers formations. Didn't want to mention them today, but they're very, very easy to spot, but they're all based on what we discussed today. If you can't spot the candles we discussed today, you will not be able to go to the next step and get the more complex candlestick formations of the entries. Absolutely, Thomas, you got it. And I was going to talk to you about it today, but because of this, we've got to go tomorrow. But absolutely, tomorrow at 1 o'clock, you and I are on. I'll be more than happy to talk to you about these. So we're going to look for low risk, high probability winning entries based on all the information we got today. So I'm at www.rightlinetrading.com. You can email me at info@rightlinetrading.com. My number is 1-855-765-6681. And I just want to go really, really quickly back to the top and show you again the syllabus. It's right here. So 1 and 2, this is simple price action. 2 is going to be complex price action. In 3, we must trade with volume. If we don't, we're going to have a problem. We have to leverage volume. Remember, there are only 5 parameters on a given trading chart. There's the open, high, low, close of each candle and volume. So people who have all these magic indicators that call tops 3 weeks in advance and tell you where things are going to go, they just have those 5 parameters to work with. The open, high, low, close, and volume. We have to add volume early because it's a very, very important parameter to trade with. Then once we have our complex price action patterns, we're going to add market structure. And then we're going to have market structure and indicator confirmation. And then 8, 9, and 10, which are real critical again, are trade management strategies, how to set them up. When you get a winner, how to milk it, how to guarantee or optimize your chances of getting a winner. We're going to look at market scanning for those who want to trade stocks, to look at 100 instruments at the same time, and then we're going to do some live market trading. So listen, everyone, have a really great afternoon. I hope you really learned a lot because it's just the start. This is the basics, but this is really important. And I'm telling you, 99% of day traders don't have a clue of what you just learned because no one teaches it to them. They're being taught about Momo breakouts, calling tops, calling bottoms, and they're just not going to win. This is how we're going to make money. And I hope you can see early on how these kinds of setups and spotting them are going to give us really great winners. So everyone have a great, great afternoon. And hopefully I'll see everybody back here next week. Take care. Have a great, great afternoon. Bye-bye.